Well, good evening and welcome to our Opportunity Showcase. My name's Robert Helms, and I'm thrilled to have you with us, whether you're watching the recording or you're with us live. Tonight's Opportunity Showcase is about co-living for higher ROI. If you don't know me, I've hosted the Real Estate Guys radio program now in its 30th year of broadcast, and I've spent a lot of time investing in real estate. Our show is heard in lots of countries and lots of places, and you can download it at all your favorite podcast outlets. We do have a disclaimer. We don't have a disclaimer on the radio show, but we have a disclaimer for this showcase, and it goes like this. Everything we're sharing today is for informational purposes only. It's not an offer to sell you anything, and it's not a request for anyone to invest. And the actual opportunity offered will come with official documents, paperwork that spell out all the details, the costs, the risks, the potential returns, and any mandated disclosures. Nothing that you learn tonight should be taken as financial, legal, or tax advice. Even though both of your presenters have a lot of experience in real estate, we don't give advice. We share ideas and information. You're expected to do your own homework and talk with your professional advisors before making any decision. Any projections or forward-looking comments are simply estimates and not promises. That wasn't too bad as a disclaimer, right? Not too much legalese, but the point is, this webinar is different from our radio show. On the show, whether you listen on the broadcast version or on the podcast, wherever you work out or drive or however you listen to your podcast, those are just, guests and ideas, and there aren't actually any deals and nothing for sale. Tonight's a little different. We're going to share with you a concept and some education behind it, but if you're interested, there is opportunity. In fact, it's an opportunity I'm really excited about. So having been a real estate investor for a long, long time, I've had the pleasure of investing in all kinds of stuff. But I would say that the mainstay of my portfolio has always been residential property. And over the years, I've owned lots and lots and lots of single-family houses. You probably have a bunch of these in your portfolio. And there are some great things to like about single-family houses. A single-family house gives you the opportunity to provide safe, clean, affordable housing to somebody who, for whatever reason, isn't able to buy a home now. And if you do it right, and you buy in the right marketplace, and you have great management, then what happens over some period of time, 15 or 30 years, the tenant pays off your mortgage. And a little more besides. Hopefully they cover all the expenses and you weather those times during your holding period that there's vacancy and turnover. And I can think of no reason not to acquire dozens and dozens and dozens more single-family houses. But there are a few disadvantages to single-family houses, and I want to be upfront about that because tonight's opportunity actually counters many of the things I'm about to share with you. So one disadvantage of a single family home is that the cash flow is pretty tough at first. We say that it's always the first 2 years of any investment that are hard. That's when the rents are thin. That's when expenses are higher. That's when it's a lot of amortization, a lot less amortization and a lot more interest, right? The first couple of years are tough. Doesn't mean you shouldn't buy single family houses. It means that it's hard to make them work. It's also all or nothing occupancy. If I have an apartment building with 100 units and 3 of my apartments are empty, well, then I have 3% vacancy. But a single family home isn't like that. A single family home is all or nothing. It's 100% occupied or it's 100% vacant. Now, if you get a portfolio of enough of them, it evens that out. But if your first investment is a single family home, you just have to be ready to weather the times when tenants leave. You have to come up with the money to make ready the unit and get the new tenant placed. So it's all or nothing when it comes to occupancy. Rents are softening in many markets. Not forever, not a ton, but they are softening. And when that happens, it's just a little harder to make the numbers work. When you do have turnover, it's expensive. It can cost you 1 or 2 or 3 months worth of rent, depending on how well your tenant was screened. And let's face it, one of the glaring things we have right now is high interest rates. Now, Jim and I have been investing for a long time, decades. And so to us, we look at interest rates at 7, 8, or 9 and go, well, that's not so bad. We've had worse. But if you've only invested for the last, say, 10 years, well, then you're thinking interest rates are high. And I'll give you that. Compared to where they've been, interest rates are high. That's why some people aren't investing at all right now and why there's more opportunity for you. So high interest rates, increased expenses, things like insurance are going up. Some property managers with less business are having to raise their fees. And so there's a lot of things that we love about single family, but there's also some things that we don't. And just to be candid, I speak at a lot of real estate events. Every event I've been to in the last 12 months, except for two, has had less people than the year before. Substantially less people in some cases. I was just supposed to be at an event that I didn't go to at the last minute, and that event was down almost 50%, folks there told me. The two events that actually have had higher occupancy in terms of the seats, people in the seats at the events, have not been real estate events. They've been precious metals events. And so right now, real estate's kind of out of favor. We got a lot of listeners that are like, you know what, interest rates, it just doesn't pencil today. And we hear you loud and clear. So what's an investor to do? You have to think outside the box. Now, you've heard that your whole life. Think outside the box. What does that mean? Well, you have to think of the different possible uses for a single family home, not just the one. Certainly, you can rent a single family home to a single family, and most people do. But you'll notice there's more space on my slide. There's a lot more you can do with a single family house. You can have it as a short-term or vacation rental, and that can be great business in the right marketplace. There was a time when short-term rentals were all the rage and everybody was buying one, and then the reality set in. They don't always work. But when they do, they can be great. Now, there's also a midterm rental. So that means you're not renting it for a week or a weekend. Instead, you're renting often a furnished home to someone who stays longer, someone who's going to be in a market for a quarter or 6 weeks, someone like a traveling nurse, someone whose home is being built and it's not ready, but the kids need to get into school, right? A lot of reasons that those midterm rentals can work, and you can make good money. The challenge, of course, is longer vacancy periods. What else can you use a single family home for? Well, student housing. For many years, I was the on-site manager of a 48-unit apartment building a block from the school I went to, and there were lots of houses where they would rent out the rooms, and that worked quite well. Also, commercial retail space. Now you're thinking, wait a minute, you can't really put like a convenience store in my neighborhood. Well, that's true, but I bet you can think of a place in your town where there are what were once a street of single-family homes that today are offices or stores or retail. I've been to dozens of those places over the years. So eventually the use can change when it comes to single family. And then one of my favorites, residential assisted living, where you put a whole bunch of folks into one home. Now, there's a lot to learn there. There's a lot of rules and regulations and so forth. But the idea is it's not just one use. It's multiple use. So the thing we're going to talk about tonight is something called a master lease. A master lease works well when you have a single family house and you have different roommates. And rather than you having to manage all that, and this one's here for a week, and that one's there for 3 weeks, and this one's here for 3 months, and who takes out the garbage and all that kind of stuff, a master lease can alleviate some of that. And so that brings us to our topic tonight, which is co-living. Now, co-living is not a new concept. My second investment property was a 7-unit building with 7 bedrooms, 2 bathrooms, one other bathroom that one of the units had to itself. The other 2 bathrooms were shared by 6 of the tenants, and a common kitchen. It's an old Victorian property in San Jose, California. Today it's over 150 years old, and it's still set up with 7 individual apartments. When it was built as a big house for a wealthy family. It's over 4,000 square feet. But today, it's apartments. And so co-living is the idea of taking an existing asset like a single family home and cramming more people in there. Now, it's not that simple, but I will say that co-living is taking off. And there's a lot of reasons for that. I'm sure our guest will share some of them. I will tell you that at the cost of living in the more expensive areas, this is just how you get the workforce to live somewhere. And so there's a bunch of great co-living arrangements that you can come up with. A fraternity or sorority is co-living. There's things called rooming houses. That's co-living. But tonight we're going to talk about an investment that gives you kind of an edge and counters the things that we've been talking about. If you were to look at today's co-living owners, most of them are going to buy a 4-bedroom, 2-bathroom house, and they're going to add rooms. Yeah, add rooms. How do you add rooms to a 40-year-old 4-bedroom, 2-bathroom house? Well, you put walls in and make that nice big room 2 nice smaller rooms. You might even add a bathroom. That's going to take permitting. That's going to cost money. And you know what? Not all lenders like that. They don't like when you change severely the collateral. And so turning a normal single family house into a co-living home comes with challenges. But if you do it right, there is awesome opportunity. So tonight we're going to talk about the idea of the best of both worlds. The first world is co-living, and the second world is brand new investment property. And to help me do that, I'd like to introduce you to our guest. Jim Sheils has been a friend of the Real Estate Guys for a long, long time. He's been an investor for more than 2 decades. He has done tons of rehabs, ground up construction, build to rent. He also happens to be the author of these 2 fabulous books. This is a book you're going to want to read if you have kids or are planning to. It's The Family Board Meeting. A wonderful premise that he and his wife Jamie came up with is you don't have the whole amount of time with your kids that you think you do. You have 18 summers. And of course, a Real Estate Guy's standard book we like people to read is Passive. This is the Passive Income Playbook that Jim and Jamie put together. So with that, let's say hi to our friend Jim Sheils. Hey, Jim.
Evening, Robert. Good to see you.
It's always good to see you, my friend. We get to bump into each other quite a bit, and love what you guys are doing. Jim has worked with his partners at Southern Impression Homes, helping investors get brand new single-family houses, duplexes, quads, and even some bigger stuff. But tonight, that's not what we're going to talk about. We're going to talk about this idea of co-living because you guys have found a really super niche. So with that, I'll let you take it away.
Thanks, Robert. All right. Well, I appreciate everyone being here. I've gotten to speak with the community quite a few times, but not about this, not about co-living success, a new niche that we actually got into kind of thanks to Robert. And I'll tell that story in tonight's presentation. Again, we are not giving investor advice or accounting advice or legal advice tonight. We're here to talk about real estate, and that's what tonight's all about. So tonight is going to be about Southern Impression Homes and Pad Splits. Those are the 2 companies that I'm going to be talking about. I'm a partner at Southern Impression Homes, worked with the founder, Chris Funk, for many of years, and merged my company a few years ago to completely join forces in Pad Split. Again, Robert actually was indirectly the introduction to the founders of Pad Split for us. And tonight, what I think is important for an investment to work, and we're going to really go back to this simple strategy. And what I've found for us, for the investing that I've done for the last 27 years, I know with a lot of the investors we've worked with, these are the 3 components that create success. You got to build right, you have to finance, and you have to manage right. I'm going to talk about all 3 of those tonight separately, especially in the management right. We're going to go pretty deep into co-living and Pad Split system that they've designed and is helping now thousands of tenants and investors nationwide. So a little bit about me, that first real estate class many years ago. Robert knows I was with Robert Kiyosaki in Phoenix, Arizona. Spent $5,000 in the mid-90s. People thought I was crazy, but I didn't care because I wanted to make passive income so I could have active freedom and be on the beach more like in this picture and in the office less. And I have had quite an adventure in real estate that I'm very grateful of, and I would never change that. My first deal out near where Robert started out in Lompoc, California, I bought it for $152,500. Today it's worth $865. I sold it in 2004 when I was coming to Florida for $570 and 1031 exchanged it into other properties here in Jacksonville, Florida. Here I am. This is me with a lot of paint on me. That was my bleach blonde hair at the time. I look a lot younger, but a lot messier. And what I learned, Robert, was I wasn't very good at rehabbing properties. That's the funny thing, because people are like, well, wow, you've done over 2,000 rehabs. Doesn't mean I was good at them actually doing myself. So I found that I had to find teammates around me to help me with the rehabs and learn how to manage the system. And it worked really well, but something didn't work well, Robert. And what I got into, and I know you and I have talked about this in story time on the show before, my old fixer-upper model when I was doing bulk rehabs, it definitely made me money, but it bankrupted my time. And as I started to grow a family and want to do other things and get into other activities, I had to change the way that I was looking at investing. Now, the fixer-upper model got me there, but really it prevented me from taking the next step. And one of the big things, and I'll talk about a few things that I found with fixer-uppers. And again, truth be told, I own fixer-uppers still that I've rehabbed. But there's certain things I know about my old houses. One of them is the 3-year curse. What I found after doing hundreds of properties here in Northeast Florida, even if I did a new roof, heating, cooling, plumbing, kitchens, baths, it seemed that after 3 years, I had to up my maintenance and repairs. It just was bound to happen. And so that was something I had to be aware of. And I didn't really like that for myself and certainly not for my investors. And what helped with that was new construction. It really did change everything. When we went to the new construction model a little over 10 years ago, Robert actually was one of the founding people with us, working with us on that. And what we found was something very interesting over this last decade. Our average tenant time went from 13 months on our old fixer-uppers to 3 years. Our average turn cost, they decreased by 75%. And rents and value increases seem to be significantly stronger and more steady than our old fixer-uppers. So that's why I completely hung up my rehab shoes for the most part about a decade ago, because new construction seemed like the way I could better help myself and our investors achieve their success. Now, a lot of this is in the Passive Income Playbook. It became a USA Today bestseller. My wife and I put a lot of heart and soul into it, along with my partner, along with people from the Real Estate Guys community. There's a lot of other stories in this book. So if you're looking to find about our journey of how we went from fixer-uppers to new construction and then to other avenues, just go ahead and scan this QR code. You get a free copy of the book, and it really is a great read with a lot of influence from the Real Estate Radio guys.
Good stuff.
Again, yeah, oh, it's great, Robert, and we appreciate all your help with that. But again, I'm going to keep anchoring back to this. Our goal tonight is to talk about building right, financing right, and managing right. Now, here I am with Robert at one of the events that I can't remember which one this was, and I've known Robert for a number of years, but not as long as this guy. My partner, Chris Funk, and his father, Carter, started the company many years ago, and I actually started working with Robert through Chris and Carter. They're the ones who introduced us. And it's been a wonderful partnership that has grown tremendously. You know, our team started with only a few people and has grown to quite an enterprise at this point. And all we do is we focus on investors who want to own investment properties, whether that's individual investors like you and I, or even some of the larger institutional investors that ask us to build them new construction properties and help them with the overall financing and management. Our old office, Robert, you've been to that interesting part of town in Jacksonville that we started in, not to be fancy, and then our latest office where some of the real estate community has come to, and we're very excited with the growth. And a lot of that growth happened because we were partially acquired by Sumitomo Forestry. They're over 300 years old. They build 17,000 homes worldwide every year. They have put us in a position where we have no bank debt. We're able to get incredible mortgage deals, which we'll talk about, and some of the best pricing available for high quality investor property new construction. We're now the 5th largest builder in the US with Sumitomo and all our sister companies, which allows us to build all over the US. In larger projects, in smaller projects like co-living, we are focused in Northeast Florida because our work that we've done in research with Pad Split. But we've been able to produce really a powerhouse effect that I never thought could have happened 10 years ago when we first got into new construction. Currently, we have over $1 billion under asset management, over 1,000 active investors, over 10,000 units developed, over 11,000 residents housed, over 140 people on the team, and that's growing by the week. And again, our whole goal, as you know, Robert, is we need to build right for our investors, we need to finance right, and we need to manage right. Now, the building right, I've kind of already given you the cheat sheet. For us, building right is about new construction. Now, again, I love old construction properties, fixer-uppers, I still own them, but for ourselves and for our investors now, we stick with new construction for all the reasons that I listed before. Now, once you get a new construction property, also financing right is really important. And one thing that we've been able to develop now that we have a very healthy balance sheet, we have no bank debt, we're able to actually work deals with mortgage companies that you couldn't work on your own from the general public. So right now with our co-living properties that we're working with Pad Split on, we've been able to work our own in-house financing down to 5.5% interest. That's on a 30-year fixed loan. And that's very important. I'll tell you why, because if you haven't worked in co-living yet, the banks don't really know what to think of it just yet, Robert. They're just not sure. So they're going to look at it a little differently than a normal investment property. And the average financing right now, Robert, that we found for co-living properties is about 8.25%.
Yep.
So we're bringing in our interest rates almost 3% lower on a long-term fixed rate for our co-living investors working through pad split. So we're really excited that we're able to bring that part of the equation to life. Again, we can go through this with one of our property counselors. This is just an example of our 1414. And when you look at the difference of if you're using our in-house financing compared to an outside lender, putting 25% down when you have the rate at 5.5% opposed to 8%, well, your mortgage, as you can see on that line number 4, takes quite a jump and eats into quite a bit of profit. And your annual cash flow goes from over 14% to 8%. Now, 8% is great, especially in today's market. But if we can put an extra 6% in your pocket in year one, cash flow, as Robert was saying, is more difficult right now. Well, heck, we're all about that. So,
hey, Jim, just a quick
yes,
thing. So
absolutely.
no investor left behind. 1414 isn't something we're used to hearing. So rather than take an old house and add some bedrooms in a creative way so people can live under one roof and bring the ROI up, what you guys are building is brand new 14 bedroom, 14 bathroom houses and
Yes,
7-unit, which 7 bedrooms, each with their own bathroom. They rent for more and a pad split if they have their own bathroom, and even 20 bedroom, 20 bathroom units. So this is just a quick snapshot on a bigger property.
Yeah, good slowdown, Robert. And you bring on an interesting point. As you know, I mean, rehabs are what made my bones for the first 15 years of investing.
Yeah.
And I can't tell you how many hundreds of properties I turned from 2-bedroom, 1-baths into 3-bedroom, 2-baths, from 3-bedroom, 1-baths to 4-2s or 4-3s. Man, but when some of the investors started to come to us from pad split, and again, the interesting story, that was when you brought me on stage at Limitless and you had that panel. And then some of the founders where we talked about new constructions, the trends. And after I got off that panel, well, one of the principals of pad split approached me and we started to strike up kind of a investor conversation and friendship. They lived in Northeast Florida, and over the last 2 years, I found what I went through in the passive income playbook, just going from smaller fixer-uppers to new construction. They were going through the same pain. Like you said, holy moly, taking a 3-bedroom, 2-bath old property, 50 years old, and turning it into a 7-bedroom, 7-bath. Wow, you are talking about a really difficult process that people were starting to learn. It's doable, but it's a lot harder. And what we learned is if you can just start from scratch, start with a clean slate and go the new construction route, holy cow, all those things I said, less maintenance and repairs, less headaches, less surprises. That's what we've been able to provide by starting right off the bat, by modeling these houses, not as, you're adapting something, but a completely done for you house, really focused on co-living. It almost is like an unfair advantage. And the rehabbers are starting to knock on our shoulder pretty actively now, saying, man, I'm tired of converting. The cash flow is great once we get there, but these conversions are tough. We'd rather go new construction. So look, once again, we've talked about build right, where we've gone from the old fixer-upper model. We've talked about financing right, where we're trying to get you our in-house financing to get you in almost 3% below what the average rates are, and that goes right to your bottom line cash flow, to managing right. And I think this is what most people showed up for tonight. A lot of you have worked with us. We're very, pleased and appreciative of all the decade plus we've gotten to work with the Real Estate Guys community. But what we've decided, even though we do our own long-term rentals, we did not want to manage these properties. And I'll tell you why, because it's an expert niche. Just like short-term rentals, I own some short-term rentals, but I don't have them managed at Suncoast because that's not our specialty.
Right.
And when pad split was introduced to us, again, thanks to you, Robert, coming off that panel at Limitless a few years ago, it was clear they had put a lot into this. And me, being the investor skeptic, had a lot of questions, and they answered them really well. And I'm going to share some of their slides tonight because they are our managed right partner on this. These are the ones that bring in that third part of the equation that is so important. So what I learned from Pad Split is a couple of things. First of all, a rooming house, which can be a great way, is a little different than a pad split, than a co-living, because rooming houses are offered to the public, and that's where residents do not operate as a family. What they do with pad split is it's not offered to the public. You have to be a pad split member, and only the members can gain occupancy rights to the property. And that's after they apply and are granted membership in a limited liability company that rents the property and are approved for move-in by the property owner. So only pad split members can occupy a property. So I thought that was really ingenious for lots of approvals, for lots of legalities, that they have a membership for their pad splits and co-livings, which simplifies a bunch of things.
That's a big point, and it's a unique selling proposition. Because if you think about it, if I own any kind of rental property, I am beholden to the laws and the tenant and the property manager. And in this case, I was certainly concerned when I first met Atticus at Pad Split about the idea of these strangers living together in my house. What happens if they have arguments? What happens if one doesn't clean the dishes? They're sharing a kitchen, right? And just like this sounds like a recipe for disaster. But in fact, this membership model is what makes it so unique, and the recourse that you have, and not only that, the legality. You can see on the slide here that legally, members of an organization or a company, an LLC, qualify as a family, meaning that you're not going to get any hassle from these folks living in a neighborhood. Now, obviously, a purpose ground up built property is even better. Many of the pad splits, the bedrooms aren't all the same. They aren't all as nice. Some have bathrooms, some don't. You guys have really figured out how to engineer this so they're all as similar as possible. But the membership part is super unique. You could try to compete with that, but my goodness, that is a heavy load.
It is. It really is. And so, and they've learned this is now qualified as a family, kind of like you said, Robert, as a sorority or as a fraternity. And again, not to go back into the building phase, but on these properties, there's only one utility. So utilities are included and they're shared. It's not like an apartment building where you have individual utilities. That would be a big no-no, especially in the neighborhoods that we're building in. But when there's under one utility, and they're now members and they qualify as a family, you're staying within the codes and the laws, which is very important because you don't really want to try to go under the radar. That's a very short-term approach that can cause a lot of headaches, and we don't like headaches. We like simplicity, we like probability, we like good leverage, and that's what this will bring you. A couple of things too. You're saying, well, who's renting these? Well, this is something that was brought to me, and I actually double-checked, again, came straight from Pad Split in their presentation originally to me, and that's nearly 50% of U.S. working class cannot qualify for a one-bedroom rental. Now, Robert, I don't know about you, but if you look down there in the middle, the average rental is $1,641. $1,641. I thought it was only $1,300. So,
it was.
Well, yeah, right?
It just isn't now.
I've become the old guy, Robert, when I say I remember when, and
you and me both, buddy.
Right, I'm just catching up with it. But we're not talking about some huge fancy place. We're talking a 696 square foot, one bedroom or studio apartment. That's very expensive. Now, let me back up, and we'll get to these numbers in a minute. There's a big difference between $1,641 a month plus utilities, other setups, maybe cable. Compared to an all-in for, let's say, $850 a month. That's a huge difference for someone who's working hard, trying to get ahead, try to save money. And again, the larger population is now single. There's not as many larger families, which I've seen for family rentals and such. And this is very important to know. You don't want to build something and just expect people to come. You want to do the statistics and see what's needed. And what we're seeing is this workforce housing. We all hear it. We all know the affordability crisis has to be answered in some way. It cannot be answered by one bedroom apartments. It just can't.
Yep.
And that's why we have to look at other ways of, again, co-living and looking at this team family approach, master leases with individual rooms built correctly, where again, this can literally be cut in half, Robert. And that's a major difference to people being able to have a good place to live and start to get ahead finally.
Yep.
Proven system. This was really interesting. First of all, a couple things I liked about Pad Split when I just really drilled them. They don't collect rent monthly; they can collect it weekly. Most of the people that they're working with get paid weekly. They get it set up that way. It's not seeming like a bigger amount. They take it down in little chunks, and with their collection rate, it has a 97% collection rate. It's billed 2 days before due date. There's a $25 late fee if not paid. The termination risk is after $300 plus. So if a balance of 300 plus triggers termination, it's a 48-hour window for them to pay. So they're right on top of it. Again, they have a really good master lease that handles this. And again, when people say, well, this person might go from my pad split to the other person's pad split, not so fast. If they do not pay, their membership is terminated. This is a really important thing. The membership is terminated, and this is becoming really popular. People don't want that. That's almost like people back in the day when Robert and I used to rent to them a lot more Section 8. If they lost their Section 8 voucher, that's losing a golden ticket, really. So they wanted to be a little protective of that.
That's the exact parallel I was thinking about is Section 8, which is a whole different can of worms. But the nice thing is that the landlord gets paid on time. In this case, there's one more benefit to the membership, not just for you as the landlord, but as the tenant, is that once they're approved for membership, I talked about midterm rentals. Picture that traveling nurse who goes for 6 to 12 weeks into a new market. Well, she can be in a pad split in Jacksonville and get transferred to Orlando, and now she can go in a pad split in Orlando, and then she gets transferred to Austin, Texas, and she stays at a pad split in Austin, Texas. In order for her to have that benefit, she has to be a member in good standing. So it is huge leverage when the individual property has the right to terminate a membership for non-payment. You hold it over their head, they're going to do what they have to do to get the money to you most times, and a 97% collection rate is pretty impressive.
It really is. And again, this does show that the membership model, screening properly, and affordability is key. When people can actually afford it, I think, and they've been screened properly, then there's a much, much higher rate of effectiveness and success. When we all know you may be stretched, or maybe I'm speaking out of turn for everyone else, but I can say Robert and I have made that decision to say, well, I think this tenant could probably afford this, and we probably stretch them into something that just was out of their financial league. You don't want to do that. And this shows that collection rate really does come down to affordability. Also, the screening is not like, okay, are you a nice person? Okay, go ahead and move in. You're a member. They have a very rigorous membership qualifying. And when they do that, you can see the national average right now is 7.8%. Pad split's eviction status is at 1.3%.
Wow.
So again, I'm going to be honest here, Robert. When I first met Emmanuel and some of the other guys from Pad Split after our panel that day, I thought, man, there's no way this will work. Man, it's going to be all of these, kind of, unsavory people moving in and without jobs and criminal activity. And I've really been pleasantly wrong. And
it's such a good point, and I've heard that as well. These are folks who are hardworking, typically have jobs, have some wherewithal. They're trying to get ahead, so they're trying to lower their housing costs. They're single, they don't need a big fancy place, and yet they know there's a safety in this membership, because not only have the tenants all been screened, but so have the landlords and the properties. And they know they're not going to get into some dumpy place, especially with these new builds. And I think the other part about eviction, most of us on this call tonight have probably had an eviction. And when you have a tenant that has not paid and refuses to pay, they're usually into you for a month's rent, a month and a half. Now they got to come up with $3,500 plus fees. In order to cure your pad split deficiency, it's $300. Right? If it goes over that, that's when they start. So I would guess that if I'm facing being out on the street, I'm going to use whatever resources I have to get that paid. And because these people have been screened ahead of time, they're the type of people that generally are able to do that. Not all tenants get it over the line, right? When they rented, they expected to be able to pay, but life happens. But I think eviction rate at under 2% is pretty awesome.
Yeah. And if you look back, Robert, on this last one, a member must vacate within 24 hours when they
They've
terminate the
agreed to
membership.
that in their membership.
Yes. So this is a very, very unique approach. Things that when I was starting my investing in Central California years ago, Robert, golly, I wish I had that.
Yeah.
So I
And
certainly
if
did.
they're only in one bedroom, they probably don't have that much stuff anyway. It's easy to pack up and go.
Exactly, exactly. So again, what's interesting too about the pad split model, like Robert's done a great job trying to assimilate it to other models. I would say right now it reminds me of a two-layer approach, like with my short-term rentals. Like my short-term rentals, they're not with Suncoast, our sister company at Southern Impression, because we only do long-term. But I have them listed on Airbnb. But I also have a local property manager that kind of handles things like you're seeing, creating listings, setting pricing, all the things of onboarding, move-in, member and property management, termination, move-outs, collection thresholds. I have someone that does that for me on my short-term rentals. I also use VRBO and Airbnb, but I have a two-layer approach. That's the same thing that happens here in pad split. So to be clear, right now, what we've done for the research that we're working on directly with pad split, not only where are properties needed, where do we have experience, but also where do we have the available lots that will be approved? Well, that's here in Jacksonville and Northeast Florida. That's where we're starting this program and have gotten off to a great start. And here we have both the pad split membership set up very well. It's been tested. They need more properties. But we also have property managers, some that we know and that used to be part of our team, that are doing specifically this and doing it well. So they work hand in hand with pad split, where they can do the host responsibilities and the pad split responsibilities. Now, if you want to get involved with some of this stuff on the left-hand side, have at it. For me, I really like turnkey. I don't like being involved in my own rentals. I kind of want to be out of it. I want to step back. I don't want me to know who I am. And I like to hand this part off. I'm more interested in doing the deals and building houses. I don't want to manage any part of my rental properties. That's something I decided with my wife a long time ago. But you have the choice. But what I like about this is pad split is very clear when you onboard with doing a property with us, and then with onboarding their management, they'll be able to set you up with not only them, but the preferred member, the preferred property manager that works underneath in unison with them. And you'll know very clearly what you're responsible for. Now, right away, if you want to say, I live locally, or I want to try to manage this from afar, not what I'd recommend, but everyone has their own choices. You'll be able to know which things you'd be responsible for and what pad split. But this is a great chart, and we'll make sure you guys get copies of slides and be able to have your calls with pad split as well. But this is the division point, Robert. I don't know if you've ever seen this before.
No, it's a really cool thing. And I think part of it is that, it's if you think about like apartment buildings, you often have asset management and property management. And the property management is the one who's there dealing with the tenants, dealing with the day-to-day. And then you have a bigger group, could be part of the same company or different companies that are working on the more strategic stuff. And this, when you think host, if you have short-term rentals, well, okay, I'm an Airbnb host. You could take on the host responsibilities. You have that flexibility, but locally there is a host that can handle these for you. So I love the fact that there's this flexibility, and moreover, they've really thought this through. It's probably, I don't know, maybe 4 years ago, I got on a call with Atticus, one of the founders,
Yep.
talking through the model, and it was just, I'm trying to get my head around it. And this was one of the most unique things that evolved, was this idea of the host versus what pad split corporate does, if you will.
Yes. Yeah. So you have the pad split expert and the membership there, and then a property manager, a PM working underneath them. So again, tonight is all about, I'm going to keep anchoring back, build rights. We like new construction. We like it done right from the get-go, where you're not remodeling a 3-2 to become a 7-7 or a 5-5 to become a 14-14. You're getting the right financing and you're managing right. We went through a couple of those things. And one of the ways to manage right is there a demand for the properties? Hopefully we've been able to show you that, because again, here in Jacksonville, that affordability crisis has become real. And with more replaceable income jobs that are there, people need something just like this. So let's look at a couple of real live examples. And again, we're not going to spend too much time on these. Again, if you want to go through this, Robert will be able to guide you over to one of our property counselors. He's worked with the community's worked with them for years. Some of them are on this call right now. Fantastic investors themselves. They will walk you through this. And what's cool, as we teamed up with PadSplit, they actually helped us design these with the PadSplit founders, because we wanted to get something that they'd already worked with investors, thinking like investors. And we're pretty excited about these. So this is one of our models on Cone. It's a great property, 7 bedrooms, 7 baths, 84 square feet. So Robert, you say, well, that's a single family home. It is. It's got a lot less living space and a lot more bedrooms set up for the co-living. And if you look at these initial numbers, again, we can go through these in more in depth on one of your discovery calls. But this thing is bringing in an average of about $78,000 a year, with about $43,000 in expenses. Now, what I like about this, you might say, wow, those expenses are high. And I appreciate that. When they first came to me and PadSplit was putting together the performance with me, what I liked about this, Robert, is let's not sugarcoat. There are expenses to running these properties, but there is plenty of meat on the bone. So even with taking that out, taking out the debt service, you're still almost $18,000 a year. Now, I'd like to say this property, if you were buying it, putting 20% down, you would probably cash flow this off the bat about $3,000 a year. So your cash flow on this is literally going up 6 times. That's quite a big amount. And that's where the first year, where again, we're in more of a season where it seems like things aren't penciling. Well, you're almost getting a 10% rental yield with a great ROI, and your cash to close, again, the average of about a single family home. So this is another model, 1414. This is going to bring in about $156,000 a year. There's going to be expenses that they account for here. You're going to have debt service, but this is going to bring in about $35,000 a year, a little over $35,000. This impressed me because I know right now with similar properties, if you're renting these long-term, you're probably going to only make about $15,000 a year. So to increase your income by 2x on a property like this and still be able to get that larger rental yield of almost 10%, that's something I feel really good about. And again, you're looking about the same price as what we were selling our quads for, our individual quads. I know there's some people on here that own quads with us, but again, this allows us to get you the right cash flow for what's needed. What's needed right now is this workforce housing for people earning under the average income needed for the area, not because they have bad credit or anything crazy like that. They just don't have the job paying enough to handle that $1,500 a month plus utilities for a 1-bedroom or studio. This is the solution. So these are 2 of our models. We also have a 2020. I didn't include that in here. I figured the 7.7 and a 14.14, Robert, would be a great start.
So I'm imagining we have a few folks who are trying to watch this on their phone, and the floor plan's a little hard to see. But take us through, Jim, what the common areas look like. We'll start with the fact that every bedroom has its own bathroom. That's not true at every PadSplit, but it's true here. And I think that's a huge advantage when you're trying to attract a tenant. They have their own bathroom. They don't have to wait in line for the bathroom. Having owned several houses where we have tenants that are sharing bathrooms, it's not pretty in a lot of ways, but there is some common area, the kitchen area, and take us through what that looks like and how these types of tenants get along.
Yeah, so in these front area, and great point, Robert. So just know these are not first drafts. These are about 20th drafts here. So what was really cool when we designed these, our goal is always to, how do we get the best returns for our clients with the most amount of safety score? And what we found when we started to go through the research with PadSplit, there is a demand for shared bathrooms, but the rents dropped so much that we found for the price we can get construction done, if we gave everyone their own bath and those seem to be in higher demand, we could up the return and the value of the properties.
Yep.
So we tried to do it both ways, where we tried maybe, hey, some 7-bedroom, 4 baths. Some for this 1414, I think originally we had 10 baths, but we found to do the numbers and the surveying of people who are actually renting these, having their own bath was absolutely key. And we kept shrinking the common area because all you have is a small kitchen. If you look in this, there's in the 4 different ways that we divide this up, there's the small kitchens in the front, and then there's usually room in the back for a small laundry. And so that's all. This is all bedrooms that you would think of like a rooming house with a small shared kitchen, their own private baths, their own entry doors to their rooms. It really is a success for what people are looking for today.
Good stuff.
Yeah. So again, these plans are hard to see, guys. We can get you copies of the slides, but this really does start to show you what it looks like. If any of you guys have built new construction with us and seen the plans, you're seeing a lot less common areas. You're seeing a lot more bathrooms. But these are all things we had to account for. And also you have to get approved for. That is so important. I can't tell you when people say, what should I watch for if I'm going to do a co-living property? Now, obviously I'm saying, well, I'd love for you to do it with us if you decide to do one, but let's say you're going to another area. I think that you don't want to fly under the radar. I know you never recommend that, Robert. It's very short term, and you have to go by county guidelines, city guidelines to make sure you have enough parking, which we found is about 50% of the rooms that you have. You need about that amount in parking. There's other things, again, where you want to stay in good standing with your county or city. And so you have to do that right. The nice thing about new construction, we got to go by the book. We got to get things submitted the proper way and approved the proper way. And that gives you more value than someone who might be slipping under the radar, grabbing a few extra bedrooms, an extra bath or two, and maybe not setting it up properly, where the city or county could come in and fine you and even do worse. So we like to keep you in good grace. Again, some of these are set up too, where we're looking to divide up and do duplex models, where you can buy a 7-7 on one side and a 7-7 on the other side. You can own both. You can go with a partner, but we are really trying to utilize space in areas that there's great need, where there's job source, where there's public transportation, and where you can actually get them approved. And right now, I'll go over that in a minute. Again, some more plans. This is really something to go in depth on more with your property counselor to go through the plans. But I can tell you there has been a lot of whiteboarding on this, a lot of work with our team and pad splits to say, what will people like, what will make them stay longer, and what will make the investors the best return.
Jim, you know, you've got history in being in different markets and researching the markets, and that brought you and your family to Florida because there's great opportunity there. That's where you're starting this, but you guys have also built in some other markets. And I think the big picture here is that entrepreneurs figure out how to solve a problem. They figure out how to serve a need. And one of the needs we see all over the United States and even other countries is when a place gets popular, the cost of housing goes up. And yet when there's a lot of increase in population, there's a need for jobs. And they aren't all $100,000 a year jobs. And so the folks that are working in these marketplaces, because there are jobs there, because there's demand there, can't afford a 2-bedroom apartment. They can't afford a house, but they can afford this. And it's creating a need. If what I wanted to do was just go build a 300-unit apartment, well, good luck finding the land. And in order to do that today, you're going to have to go on the outskirts of town, and over time it'll become popular. But you guys are able to build on infill lots. You're able to build in markets where you know the demand is there. And that's the exciting thing about this. It is still residential living. It's just different because of the need, and bringing the cost to the tenant down is huge, rather than just lower the quality of everything, which is what some landlords choose to do. You guys have just designed it from the start to meet the needs of this huge group of people.
Yeah, we're very excited with it, Robert. Again, people, you got to solve problems. And the problem of, okay, same thing that we went through, Pad Split went through, and they're like, God dang, these fixer-uppers are tough, especially adapting them. And again, the financing, and then where is the need? And we've really, and how do we get cash flow today? I didn't like that when people said, "Oh, forget it, you can't get cash flow." This proves you can. The program has gotten off to a great start. Definitely a lot of lessons, but now we've really hit a stride of exactly what people want, how the best way to build them. But there is an approval process. I mean, as you know, Robert, we own over 5,000 lots in Florida. Right now, focusing in Northeast Florida, especially Jacksonville, where we see the need and have worked with Pad Split. We've already sold properties and currently have 9 approved co-living lots available. We're in the process of trying to get more approved, but this is a tedious process. So we do like to let them know we have 9 co-living lots available right at this time that we're going to be offering out. You can talk to our property counselors of which model can go on that. We'll have more coming available, hopefully in the near future, but these 9 are approved where we can actually get the ball rolling on them, and you don't have to worry about all the what ifs. We don't like what ifs. So we're very excited with that.
Hey, Jim, one quick thing. If you're watching the replay and this live opportunity showcase was in the rearview mirror by a few months, that's okay. Before we're done, we'll tell you how you connect with the folks at Southern Impression Homes, and you can find out what kind of inventory is available right now.
Absolutely. And for all real estate radio guys that's going to be buying a property with us, I did get this with Chris today. Any contracts signed on any of these co-living properties by August 3rd, so this gives time for people tonight and people who might listen to the replay, you'll receive a $2,000 credit at closing. You just have to let them know that you've come through Robert at the Real Estate Radio guys. That'll be given upon signing contract as long as it's by August 3rd on any of these 9 lots available, Robert.
That's awesome.
Yeah, we're looking forward to that. Well, now we come to the fun part. That'll conclude. If you are wanting to book a one-on-one consultation with one of our co-living property counselors to go through, again, how it's going to get built right, finance right, manage right, we really did skim the surface because we didn't want to keep you on all night, but they can go more into depth on performance, actual building structure, statistics, some really good stuff. So go ahead and scan that QR code. You can book your one-on-one consultation with one of our property counselors. Some of them have worked with Robert and the team for like 12 years almost. So, we are going way back now. So again, we love doing this with our investors. We love figuring out new ways that are effective and less time consuming for you. And I think we have found one with our merger with not only Robert, but also PadSplit as well.
So go ahead and keep that up there for a minute, if you would, Jim.
Sure.
And I'm sure you'll get the follow-up details. And everybody who's on tonight will get a chance to watch the replay, which we'll probably have ready to go in just a couple of days. But this is a really unique value for our partnership with Southern Impression over the years, is they have an amazing team of property counselors. These are not order takers. These are people that know the market, live in the market, know the property, have been through lots and lots of these presentations, and they really will counsel you as to the pros and cons of different areas, neighborhoods. I'm going to suggest that if you're going to invest in a market, it's going to make sense to go there and kick the dirt, see the feel of the place, meet the folks, go to the Suncoast Property Management office and meet the property managers there. Even though it's a different management system, it will tell you about the quality of the team. Watching them grow over all these years, I'm amazed at the caliber of people you guys have. But I'm not saying you have to go there. What I am saying is your property counselor is going to know the market. They're going to answer the questions, and they're also really patient. This is a new concept for a lot of folks. And to get your mind around it, you want to study the floor plans, look at how everything is oriented, understand the PadSplit management model and membership model. That's going to be important here. But if you take a look, PadSplit is growing at a really, really good pace, and that's because they have struck a nerve. They have found a way to bring the costs of tenancy down for the millions and millions of tenants that have been priced out of the market. And you and I, as landlords, can contribute here without having to jump up to 150 units. Now, I love apartments. I love big apartment complexes, but it's hard to do when you're looking at 20 bedrooms and 20 bathrooms at a price under $1 million, brand new with that low financing. I mean, I'm excited about it for all the reasons you are, Jim. So what you'll do is you'll just go ahead and book a consultation. Again, if you're watching the replay and it's been some time since we did this live, just reach out and ask what's available. It may be that there's a new market by then. It may be that more lots get approved. It may be that there's a waiting list and you're not going to have that opportunity. So with that, is that your final slide, Jim?
That's the final slide, sir. I'll stop sharing if that's okay with you.
That's perfect. And I just have a couple more announcements. And then for those of you that are on live, you can stay and ask your questions. We're actually going to edit that little part I just said out of the replay. But before we do that, I will share with you just a couple of things that you need to know. Coming up in the next few months, we have lots of great shows. Some of you just heard the show with Jim a couple weeks ago talking about this as a market spotlight, just because it's a unique way to approach a market that is a proven market, but just harder to make the numbers pencil. So when Jim first told me about this, I was thrilled. And that panel that we were on together was at the Limitless Expo. That event is also a great event. It's coming up again August 14th, 15th, and 16th. You can go to limitlessexpo.com, and if you use the code Real Estate Guys, you'll save some money. And I'd be remiss if I didn't personally invite you to come with us for the 24th Annual Investor Summit. We're doing it on sand this year, back on the sand off a cruise ship in Puerto Rico. It's going to be amazing. Just go to summitonsand.com. If you're interested in commercial flex space, that's our next showcase. This is fascinating. My son and I made a trip to Weatherford, Texas to check this out live and in person. If you haven't seen it on our YouTube channel, you can get some visuals on that, but really very, very cool stuff. And your tenants tend to stay for a long time because they are proven long-term business people. So check that out. That happens on August the 24th. That's another Monday night. Just send an email to flexopportunity@realestateguysradio.com. Flexopportunity@realestateguysradio.com. You're probably already in our list and you'll find about it anyway. So with that, we'll call it a wrap. Thank you very much for being with us tonight, and we'll see you next time on Opportunity Showcase, and I'll see you on the radio.